Elon Musk recently declared that without AI and robotics, the US is 1,000% headed for bankruptcy. This isn't alarmist rhetoric, but a fundamental challenge to the traditional growth model, grounded in a harsh reality. $38.5 trillion in national debt, with annual interest payments exceeding $1 trillion, now surpassing the defense budget. This engineer's logic bankruptcy risk assessment exposes a deep debt trap, outlines a clear path to technological salvation, and is profoundly reshaping capital markets. It is key to understanding America's economic future. U.S. federal debt is caught in a vicious cycle, with traditional growth engines stalling. Over a decade, the national debt more than doubled from $18 trillion to $38.5 trillion, its 7.2% average annual growth rate far outpacing the 2.3% economic growth. This means for every $1 of GDP created, the U.S. borrows $3 in new debt. This borrow new to repay old model signifies the complete failure of the old growth engine. Worse, the interest on the debt itself has become a fiscal monster. In the 2024 fiscal year, net federal interest payments hit $1.13 trillion, surpassing the military budget for the first time and exceeding major entitlements like Medicare. This massive sum, spent solely on the cost of past borrowing, severely crowds out future-oriented investments in education, infrastructure, and scientific research. As Ray Dalio of Bridgewater stated, the U.S. is in a debt-death spiral. The government keeps borrowing more just to pay interest, creating a self-reinforcing doom loop. In Musk's view, the traditional ways out have failed. Fiscal austerity triggers recession, while money printing causes inflation and currency devaluation. The core issue is that output growth persistently lags behind debt growth. Therefore, the only escape is to use AI and robotics to shatter productivity boundaries and achieve exponential expansion of the economic pie. Musk's technological salvation thesis forms a clear logical loop. A deep fusion of AI and robotics will spark a productivity revolution, creating massive new wealth that ultimately dilutes the debt burden. The core vehicle is Tesla's humanoid robot, Optimus. Musk calls it the ultimate money printer, and predicts this business will constitute 80% of Tesla's future value. Targeted at a cost of around $20,000, roughly half a year's wages for a U.S. blue-collar worker, the robot can work 24/7 with a lifespan of up to 10 years, offering a lifetime cost-effectiveness over 50 times that of human labor. He forecasts up to 10 billion humanoid robots globally, taking over all dangerous repetitive work, driving labor costs toward zero, and triggering an explosion in total societal output. AI acts as a supercharged efficiency multiplier, reconstructing productivity in every industry from the ground up. Musk emphasizes the real revolution is AI combined with the physical world. Already, AI has boosted Amazon's logistics efficiency by 300%, and GPT models have raised coding productivity by 50%. But the true productivity singularity arrives only when AI powers physical robots to handle real-world tasks. The ultimate vision of this revolution is ushering humanity into an age of abundance, where goods and services are superabundant and the cost of living essentials plunges. This good deflation, driven by productivity gains, would steepen the economic growth curve, potentially outpacing the compound interest on debt and creating the fundamental space needed to digest the colossal national debt. This thesis is fundamentally rewriting investment logic in the U.S. stock market, creating new opportunities while hiding multiple risks. Despite pressure on Tesla's auto business, its stock has rebounded over 100% from its 2024 low, sporting a sky-high forward PE ratio of 214, the second highest in the S&P 500. The core driver of its stock price has long shifted from cars to the future narrative around AI and robotics, with the market paying a hefty Musk premium for this tech vision. Musk's call also mirrors a national-level all-in bet on AI in the U.S. The Pentagon released an AI acceleration strategy, and Congress proposed the AI Grand Challenges Act. This national strategy resonates with market frenzy, fueling tech stock rallies and focusing capital on sectors like robotics and AI compute. Yet market anxieties are real. First, tech giants have taken on over $1 trillion in new debt to build AI infrastructure, warned by a senator as a latent financial risk. Second, valuation bubbles may be forming in AI. when giants unveiled combined annual AI investment plans exceeding $600 billion, nearly $1 trillion in market cap briefly evaporated, as investors questioned if this was investment or speculation. Furthermore, SpaceX's looming IPO, potentially valued in the trillions, could siphon off funds from Tesla allocated for Musk thesis exposure, pressuring Tesla's stock price. Yet Musk's tech is salvation argument, brimming with optimism, must confront America's deep-seated political and social institutional hurdles upon implementation. The U.S. debt issue is structural at its core. The debt ceiling, established in 1917, has been modified 104 times, rendered meaningless, and used as a political football. Social welfare spending constitutes over half the federal budget, and an aging population makes entitlements like Social Security and Medicare nearly untouchable. Polls show 70% of the public opposes benefit cuts, and 60% refuses tax hikes. This short-term political theater and societal entitlement dependency make any long-term fiscal reform incredibly difficult. Musk's pinning of national fate on a tech breakthrough is, in essence, a choice born of necessity. It mirrors his own foray into Washington politics as a radical reformer, attempting to apply business logic to cut deficits, only to be met with fierce political resistance for threatening entrenched interests. His reform effort failed within 100 days. This political experiment revealed that within the existing political framework, the logic of business efficiency struggles to breach institutional walls and fixed interest groups. Thus, for America, relying on a technological revolution to achieve economic escape velocity appears to be the only perceived path to break free from the gravitational pull of $38 trillion in debt. In summary, Musk's warning is a mirror reflecting deep contradictions within the U.S. economy. It exposes the total exhaustion of the traditional growth model while proposing a disruptive solution. Whether the technological salvation thesis is visionary or fantastical, it forces a central question. When institutional innovation is gridlocked, must technological breakthrough serve as civilization's lifeboat? For capital markets, this means investment logic is shifting from traditional PE analysis toward bets on disruptive tech narratives and future market share. But while dreaming of an AI-driven age of abundance, we must not ignore the ground beneath our feet. The compound interest on $38 trillion in debt rolls on mercilessly. Political division and social strife add volatility to this death race between technology and debt. The outcome of this race between human ingenuity and debt's compound interest is undecided, but its course will undoubtedly reshape every corner of the global economy and financial markets.